Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and I just want to wish everyone on the call today an incredibly happy and prosperous new year. Now, the stock market itself has not had a great start to the new year, and certainly we've seen that with heightened levels of volatility and concerns around the Federal Reserve and quantitative tightening and rising interest rates. So we're going to address all of that today. But more specifically, we are also going to address some of the lackluster performance results we saw in our strategies in 2021. Let me be the first to say that we do not stand by these weak performance results. It was the first year that we've ever underperformed the market. And rest assured, we're going to do everything in our power to not just get things back to where they were in 2019 and 2020, but also to claw back some of those underperformance results from 2020 as well. So, for us, our singular focus is to be the top strategy in our category in the country year in and year out. 2021, without a doubt, was a strange year, many waves of COVID, and we didn't do our job to create alpha or outperformance versus the market. And 2022, a new year has come in, and we've structured the portfolio in a way where the new year was on our mind, not trying to, catch up in the last month or so of December. So we're going to go through all of that today. And we just want as a team to thank everyone for their patience. We know that 2022, just in general, was a challenging year, whether it's personally dealing with Omicron or Delta or just uncertainty in the country as a whole. But 2022, we expect to be an absolutely fantastic year, and we're going to go through all of those things today. So without ado here, I'm going to share my screen here. So the title of this week's update is Peak Inflation, Peak Growth. Now, when we made this rotation back in November, we said that there was a few things that we really wanted to address, and that is the rules of the game were changed by the Federal Reserve. And there were a couple other things that actually stood out in November that we had to address, and we're going to go through those things today. But overall, combination of poor timing as it relates to rotating out of technology and into energy and financials in particular, right as that Delta wave hit in May, June, and July, that was really the prime factor of our underperformance. Because if we actually look at mid-August when the strategy bottomed through to the end of December, we actually generated about a net performance of 14% or so ahead of the market, which was around 8%. And we'll go through those numbers. But that was nowhere near enough to claw back some of the underperformance that we saw in June, July, and August. But overall, we think that's going in the right direction. We've had a rough start to the year, but the entire market has. But overall, we're in these names that we think actually provide the clients the potential. Nothing can ever be guaranteed, but we think the current portfolio gives the clients the best shot of, potentially doubling their money over the next, call it 24 to 36 months. And that's the way we always try to structure the portfolios. Sometimes we're right, sometimes we're not. But we think this time around we have a very high level of confidence, and we'll go through why. So 3 big things for this week. We want to conduct a thorough performance review. So we're going to go through those final numbers. Number 2, what changed in November, and have that rotation discussion. And lastly, we do want to go through some of the lessons learned for 2021 and some of our New Year's resolutions. So overall, as it relates to the year, we already kind of went through this, so I don't want to belabor it too much. But certainly that prime factor of underperformance does relate to when we rotated out of tech, which, by the way, if we look at the sales that we made in technology in March and in April, we certainly sold most of those stocks at much higher levels than where they're currently trading today, or in some cases where we bought them back in the month of December. So we're very happy with the sales. It really does come down specifically to the rotation into energy and financials as the Delta variant hit the United States, and we saw a deep correction in those energy stocks right as we were buying them. So, in one way, not something we can control, but in another way, we could have been more patient in our transition. And then obviously, as we get into the new year here, we've made a significant shift that was designed for 2022, and we'll go through that today. Now, in terms of the final performance results, what we see here is in 2022, absolutely subpar results, minus 10% versus a market that was up 26.89%. Obviously a deep level of underperformance there. When we look back at 2019 and 2020, these were performance figures, whether we were up 41% in 2019 or 101% in 2020. We are very competitive and we want to get back to that point. And so in 2022, our singular focus is that. Our singular focus is delivering by December of 2022 to come back and report to you that not only have we outperformed the market, that we're the top performing strategy in our country. That's our focus. Now, some good news within these results, as we talked about before, since the strategy bottomed on August 19th to December 31st, so important point, not including a couple rough days here in the new year, but as of the end of the year, that strategy had risen about 14.08% versus 8% for the market. So overall, going in the right direction. That includes the rotation that we made in December. So those are some of the performance results there. Overall, since inception, I think it's also important to remember, up 192.73% versus 112 for the market. So we've generated about 80% outperformance versus the market net of fees. If you're a client that's only been with us for a year, that is BS. It doesn't matter. Trust me, we're cognizant of that. And we want to get you back to levels where 3 years from now, we can look back and say we've delivered similar results. Now, for the tactical blue chip plus strategy, now this is a strategy we have much fewer clients in, but again, also a bit of a challenging year, but we did have growth. We're up 14.7% in 2021, slightly under the Dividend Aristocrats benchmark of 22.97%. This is kind of more in line with what we saw with the rest of our competition. Is most people did underperform the market this year. We know that the benchmarks are very concentrated in the 5 biggest companies in the country, and we don't own FANG. So that'd be Facebook, Apple, Netflix, Google. And a lot of times we do get that question, why don't we own these companies? Our growth strategy in particular, the opportunity strategy, is really designed at the end of the day to find out and figure out what are the companies that are going to be the next FANG, right? We don't want to own the companies that are already 2 trillion, 3 trillion in market cap, even if that means they're going up. Because generally speaking, the benchmarks already own them. Our job is to be different than the benchmark and outperform the benchmark. So we're trying to figure out what are those companies, maybe 50 billion, 100 billion in market cap, that have that potential to go to 500 billion, 1 trillion, 1.5 trillion. And certainly that's our focus always. It's not just to buy today's leaders, to buy tomorrow's leaders. And we think there is going to be a lot of leadership rotation over the next 5 years. We do think FANG in particular is primed to be disrupted. Now, a quick reminder as it relates to our investment process. Our investment process at the end of the day is a macroeconomic process, right? So when we say, hey, we're super bullish on digitization or genomics or energy, that kind of falls into the sector analysis, which then feeds into our stock selection process. The overriding framework, though, is our macroeconomic framework, right? So no matter how bullish we are on a certain sector, a certain theme, a certain company, if the macro goes against it, the macro will always override our feelings on that sector or company. So for example, we think that energy over the next 3 to 4 years does very, very well. The problem is we actually think over the next 12 months, we're facing a growth slowdown, which we'll go through later on in the presentation, but that's going to be deeply disruptive to energy stocks. So do we just want to sit down and take the punches? No, we don't. We certainly saw the effects of sitting down and taking the punches in July and August of 2021, and we don't want to replicate that over a 12-month time period. So we start with our econometrics. We look at high frequency economic data that goes across consumer data, banking data, credit data, the credit markets as a whole, and understand really where are we in the business cycle and what particular types of sectors do we want to be in. That drives our sector analysis, right? So a certain portion is going to be focused on secular growth businesses or sectors once we have the green light on the market. And then what are those quantitative aspects that we're looking for at a certain point in the business cycle. If we are just exiting out of a recession, we actually want to buy businesses with a lot of debt. Why? Because high leverage tends to outperform in the early stages of a recovery, and so do cyclical stocks. If we're in a more mature phase of the economy, or we're in a phase of the economy that's slowing down, we actually want to go up cap. In other words, bigger companies. We want to stay focused on secular growth, so companies that can grow both in a strong and weak growth environment. And we want to sell cyclical stocks because as growth slows down, those stocks tend to go down in price. And then, of course, the stock selection piece, which is once we figure out a sector, we want to figure out what are the leading companies within that sector. We don't want to buy the garbage small cap. We want to buy the leaders and, of course, buy them at a reasonable price. So what changed in the month of November? There were three macro events in November and December that forced us to make a rotation out of energy and out of financials. And this, remember, this is a 6 to 12 month picture. This is not a 1 day or 1 week picture, because certainly energy had a strong couple of days in the first part of this week. The Federal Reserve pivoted on inflation, okay? So when we look at the Federal Reserve stance on inflation prior to the 4th week of November, it was toleration and a focus on maximum employment, which means let nominal growth run hot, let inflation run hot so that we can fulfill our employment mandate. With no warning whatsoever, the Fed pivoted and said, we now need to focus on inflation. That's critical because the only way the Fed can really attack inflation is by slowing the economy down. That's the only true way they can do that. Now, the funny aspect of this is that inflation, according to our data, actually peaked in November. So you're actually getting a situation where inflation's coming down and the Fed is also stomping on the brake. So we're going to look at what are the critical aspects of that and what it means for 12-month returns going forward. Number 2 was the Build Back Better bill failed. That was going to add about $3 trillion over a multi-year time period that was going to take up GDP estimates across Wall Street models, right? So when that bill failed, we have a number of economic forecasts that now have to be adjusted lower as a result of that. So we have to adjust our growth estimates because this bill has now failed. Number 3, inflation is starting to show signs of peaking, and we're going to go through all those factors. So when we get slowing growth, slowing inflation, and a more hawkish Fed, what that ultimately means is we actually think interest rates can start to cap out and start to fall back down. And that also affects our asset allocation away from cyclical companies and towards secular growth, such as technology. So how do we put that into a framework? The Fed pivots on inflation. They need to lower growth to cool prices. GDP growth moderates. So we want to purchase cheap assets that benefit from a lower growth environment. And certainly, when we look at technology stocks over the last year, many of them are down 30, 40, 50, 60, in some cases 70% off their 52-week highs. In many cases, they're fantastic franchises. So they fit our econometric model, they fit our sector model, and they fit our valuation model. So when those three things align, for us, that's a very attractive 12-month setup. So putting this into the actual rotation trade, peak inflation, peak growth. If we're right, and that peaks out in 2022, we expect bond yields or interest rates to fall. We expect economic growth to slow down and drop as well. What does that have a result of doing? Well, that's bad for cyclical stocks like the steel companies, the commodity companies, energy, copper, those types of businesses that really rely on higher volumes to drive profitability. With what we call it a lot of operational leverage. Those stocks tend to do quite poorly, even if they're in a 5-year bull market. So we want to step away from that and focus on secular growth companies, companies that can grow the same regardless of GDP is 5%, 2%, or 1%. Those are the types of businesses that tend to outperform in that type of environment. REITs also do great. Utilities, they will also do well in a falling interest rate environment. And we see that now starting to play out in Wall Street estimates. We see that GDP estimates are starting to come down. We actually think we're going to exit closer in that 2 to 3% range. And that'll have the same impact on CPI, or in other words, inflation, rolling over as well. Okay, Robert, that's great. These estimates are coming down, but show me the beef, right? Show me the evidence that's driving these forecasts. So first of all, let's start with what we know. Inflation soared in the month of November, and it's going to be high again in December, right? So I want to be very clear about that. We're not expecting this game change number to be reported for the month of December. What we're looking for is the second derivative, right? So in other words, rate of change. Inflation rate of change accelerating until it starts to decelerate. That's what drives valuation frameworks. That's what drives flow of funds. That's what we want to pay attention to. So then we said, okay, well, what are some of the prices that are being paid that the Federal Reserve is looking at in some of their surveys? So this was the first thing that we started to notice in late November and early December, is that the prices paid and prices received by businesses was starting to roll over. Interesting. So prices are rolling over as CPI makes a massive inflection point higher. So under the surface, some of those leading indicators upstream are starting to roll over. Okay, well, what else can we look at? Inflation expectations, consumer inflation expectations, household inflation expectations also started to roll over. Very interesting. So we have prices paid, prices received in terms of the survey starting to roll over, those expectations. Then the overall household and consumer inflation expectations also rolling over. What else can we turn to? This was the Big Bang report, in my opinion, that came out this week. ISM prices paid plummeted. So this is ISM is the survey of actual prices paid by suppliers and manufacturers, or people taking delivery of supplier and manufacturing products. Prices paid plummeted. But notice what else happened. The other big driver of inflation, supplier delivery times started to collapse. So under the hood of this big peak that we saw in inflation in the month of November, under the surface, things have started to roll over. Why is that? Because this is real-time data versus the inflation data reported in the month of November is lagging, right? So we're speaking to the past. The same way when we look at a star in the sky, we're looking at the light from many, 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 many years ago. The same way with CPI and inflation. The data that we know and the data that's been reported is past data. It's not today's data. So we try to find some of this more relevant data that is closer to today to give us an indication of what may or may not be happening. And so we see these strong rollovers. Then we have to pay attention to growth drivers. So we have toleration of inflation going down, interest rates, policy rates, not long-term interest rates, but policy rates on the short end going up as a reflection of Federal Reserve policy. What does that mean? Well, we're going to expect now about $1.3 trillion of government spending that's going to drop in 2022. And that will be centered in Q2. So in Q2 of 2022, we expect the bulk of that $1.3 trillion in government spending to drop. It's going to be centered in sort of that mid part of the year. Guess what? The market always prices that in advance. So because we don't have the Build Back Better bill, right? And because we have a lapse in unemployment benefits, and obviously going year over year when those checks were mailed out to people, we're getting kind of a fiscal cliff where that spending is plummeting, and that it will be a headwind against GDP. And then lastly, we have quantitative tightening. So, we always talk about rate of change, and this I think illustrates the concept of rate of change quite well. So if we look at the chart here on the top left, we see money supply in that blue line. It's going up, 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 and up. But remember, rate of change is the most important thing. The rate of change of money supply growth is starting to plummet. And as the government, as the Federal Reserve lets some of those treasuries run off its balance sheet, this will actually go negative at some point in the middle of the latter part of this year. Maybe, unless growth really slows down, then guess what? We're back to cutting rates and goosing asset purchases. So then we said, okay, well, what happened the last time the US government did quantitative tightening? So in other words, stopped buying bonds and actually sold bonds off their balance sheet. And that was in 2015. So we see the blue line here is the size of the Federal Reserve's balance sheet. So they're running off these bonds, and the red line is the S&P 500. The bottom line message here is that the S&P 500 is really not that impacted by any means of the runoff in the bond portfolio of the Federal Reserve. But what it did have an impact on was the shape of the yield curve. So as the Federal Reserve in 2015 started to run off their bonds, what we saw here was the yield curve right here, is right where they started to flatten out. Now we had an interruption, this big bump here where the yield curve steepened. That was the Trump bump, right? When Trump got elected, there was this big inflection higher in interest rates over a 1 to 2 month period, expecting massive amounts of government spending. That never really panned out, and we went back to trend of a flatter yield curve. Why is that important? In a flatter yield curve environment, cyclical stocks, energy, commodities, financials underperform and tend to go down in price, in particular energy and commodities. So if we get back into a flattening yield curve environment, that's not good for energy in the short term. In the short term, meaning over the next 12 months. So we have slowing inflation, slowing growth, a shrinking Federal Reserve balance sheet leading to a flattening yield curve. What does that mean? Well, that's good for secular growth. That's good for REITs, but that's bad for cyclical stocks, economically sensitive stocks, such as energy, materials, the banks. So what are some of our New Year's resolutions, some of the lessons that we learned? We need to reduce some of the trading turnover from 2021. 2021 was a strange year. Many COVID waves, lots of stocks that were going in and out of the Wall Street fashion show. So we need to get back to basics, extend out our time period for toleration, and also stay focused on some of the longer term plays that are at hand, and stomach some of that volatility, even if we have a bad month or 2 months or so. Number two, we need to be less reactionary to COVID trends. The overall impact of COVID is going to continue to decrease unless there is a real game changer, like you get an Omicron-like spread, but with a much higher mortality rate. Obviously, we'd want to take action there. Number three, we want to increase the level of quantitative indicator education for our clients and advisors. So as opposed to, if you look at our weekly updates, we talk a lot about what's going on in the news and what's going on with the economy and some other indicators. What we want to specifically get more into this year is portfolio design, looking at the quant measurements that we're looking at and how that really drives not just our overall market exposure, but our sector allocation and stock selection, and piece that out week by week for clients and advisors. And then lastly, we certainly, not just do we want to outperform in 2022, we want to make up some of that lost ground in 2021. So for those clients that, certainly there's an opportunity cost of being in our strategy in 2021 versus the market, we want to begin that path of making that up. And so that's really our singular focus going into here into the new year. So, it was a frustrating year for active investors in general. That's not an excuse, but it was a frustrating year. So we want to stay focused on areas where growth is available at deep discounts. So breaking it down into 3 parts. Frustrating year, but 2022 looks incredibly more attractive with discounts abound. Number 2, inflation and growth do appear to be slowing, which has driven that allocation in the portfolio. And moderating growth, lastly, can really help investors realize value in some of these beaten up areas of the market. So that's overall our game plan here for 2022. I certainly encourage clients to reach out to their advisor if they have any questions whatsoever. We are here to help. Your advisors are there to help. We know that 2022 or 2021 was frustrating. But 2022 is a new year, and we certainly are going to attack it in a way that we think can deliver maximum outperformance. So thank you again for all of your questions, for all of your patience. And again, if you have any questions, feel free to reach out to your advisor, and have an absolutely fantastic weekend. Thank you.